to discuss a lot of these stocks with Aashish Tater of FortuneWizard.com, who joins in now. Ashish, you track some of these JP Group companies or JP Associates as well. What have you made of the fall that we saw yesterday, and how do you approach the stock now?
Good morning, Sonia. First of all, let me tell you about our report. We said that good valuations will become richer, poor guys will become poorer. That was the theme that we were talking about for the bull run, and this continues to be the case. Last year we recommended Century Textile as multi-bagger, and we said sell JP Associate and switch to Century Textile. Century Textile doubled, and at the same time at 70 rupees JP Associate has dwindled to 13 odd rupees. The basic problem with JP Group or any company with a debt bomb, what we on our study have actually shown that whenever there is a debt service of almost 1 times of what your EBITDA is or more than that, eventually this leads to higher debt, and that leads to higher interest cost, and eventually the company goes into doldrums. This has been the case in the past, and this is exactly what is being done over here. Right now Lata pointed a very interesting thing, that if you see JP selling its silver to cover up the debt bomb, but that will be only beneficial to the debt holders. What about the equity holders? If you take the rough maths, last year they did on a consolidated basis, I am talking only about the JP Associate part, 20,000 odd crore rupees of sales. And they did a EBITDA, profit before interest and taxes, close to around 4,400 crore, and their debt service cost was 7,200 odd crores. So if you adjust that, they are on 1.5 times. Even if they reduce this debt, because of the passage of time, the interest burden has again recoupled, and what will happen is that the silver has gone from your hands. These are assets which are actually generating positive cash compared to idle capacities. That idle capacities will be there. You can talk in terms of consolidated basis that yes, it is sitting on this much capacity and this should be the valuation. But that capacity is not generating any free cash flows. On the other hand, all the good cash flows have already been factored in. So this is going to create a problem for JP. That's what we feel even going further.
Okay. Would there be any other companies that you think will be unable to find enough EBITDA to pay interest?
Lata, in the same thought what we said about now when Pipavav was taken over by Reliance Infra, we felt that Reliance Infra will again be into doldrums, and we do not see that kind of problem for the ADAG group as a whole, but we feel this will subtle profit, and they will be eventually into a phase where their growth will not be able to justify with these additional burden on their assets. So there is another problem that is going to happen over there. The third interesting thing is that we feel is Adani Enterprise, though it has gone for a restructuring, but the real gem has been the Adani Port, the Mundra Port SEZ. Which was renamed as Adani Port. Apart from that particular asset, we don't think Adani Enterprise or even Adani Power will be able to match up to the expectation, because the free cash flow generation to the interest cost burden and the recoupling of the effect will be very big compared to what they can generate in terms of free cash flow. So if I consider debt plus equity service cost even at 8% or 9%, I don't think they will be able to justify even their current market cap.
Okay, so you are expecting more problems for these debt-laden companies, only increasing problems.
Exactly, Lata. If you see what we were telling, that good companies will get richer, companies with low debt profile, with brands and equity, that will be exactly the theme even going further. See what happened. Last year we recommended Saint-Gobain at 13 rupees, it's 39. We still feel it has got huge potential of re-rating. Similarly, if you own something like Unitech or JP Associate, take an example of Sri Digvijay Cement. It's trading at 15-16 rupees. It's available at $25, and it's a Brazilian giant baby. So Votorantim Cimentos, which is basically a Brazilian giant, and is trading at $25. Get me a single cement company which is trading in the zone of $25 or $35 in the cement space with almost zero debt. They're gone for VRS.
Okay. Sure. Yeah, we don't have too much time, so let's just get one more stock idea from your end. You track Nestle closely. I mean, this one has been a great wealth creator in the last many years, but now, of course, because of Maggie, it's under quite a bit of pressure. What do you advise on this stock?
See, Sonia, if you see the valuation aspect, there has been a huge wealth creation for Nestle already happened. But what we suggest is the chance of disappointment at current context. It's better to avoid this stock and switch to something like Britannia or even its holding company BBTC, because there is lot of value in that particular space, and we feel such problems will not come in over there. If you see, even if I don't see a 10% growth for Nestle this year because of all these problems, they will be doing 1200 odd crore of PAT against a market cap of 55,000 crore rupees. So there is lot of potential for switchers, and look for good value in a similar brand situation. And once thing is clarified, it's better to buy something at an expensive valuation rather than looking at a 30-40% discount after the event has actually not happened or passed through.
All right, fine. We have to end this conversation. Thank you very much. Aashish, can you tell us whether you own any of these stocks, your disclosures?
No, I do not own any of these stocks, but as part of our policy, we have recommended these stocks to our clients. We have recommended similar strategies and to our clients. So safe to assume that we have vested interest in that from that perspective. But at personal level, I do not own any of the stocks.
All right, Aashish. Thank you very much for joining us with those suggestions. So some gems in terms of stocks that you can buy, and more importantly, stocks that you ought not to buy even when the price is falling. We'll take a break on that note. When we return, we'll talk about the big spike in the global bond yields. Nick Parsons, the head of research for UK and Europe at National Australia Bank, joins us.
CNBC TV 18, celebrating 15 years of leadership. TV18, celebrating 15 years of leadership.
Hi, welcome back to the show. Well, it's flat for the markets today and we'll take that with both hands. But let's get an expert now to tell us what to expect from here on. Nick Parsons, Head of Research for UK and Europe at National Australia Bank, joins in. Nick, hi, good morning. The Sensex has fallen almost 1,000 points over the past 2 days. Is India losing its sheen amongst global investors? And if yes, why?
Well, I think we can't divorce what's been happening very recently in India from a broader move in emerging market equities. Aside from China, let's put China to one side for a moment, but if you look at the whole EM universe, the MSCI index, that's fallen for 8 consecutive days. And it's not, we have to go back, I think, to August of last year to find the last time we had 8 consecutive declines. So there does seem to be a little bit of a move away from EM more generally. I think it's tied in with an increase in volatility and a rise in global bond yields. There are perhaps some India-specific worries, but a lot of what we can see appears to be stories made up to fit the price action rather than stories actually explaining it. So in that sense, we wouldn't be too concerned with the view that India somehow is about to significantly underperform.
Well, I'll come back to that issue again. Morning, Nick. But let me go to China. You started off with the China argument. Is it that some of the investors are selling India to buy China?
It's not a noticeable one from India to China, but there does seem to be a lot of talk of US money going into it, which I find quite unusual, and I find quite surprising given the scale of the gains that we've already seen. As of Monday this week, China broke the 50% increase level for the year to date, and whilst there may be some momentum-based investors, some model-type funds who are simply chasing the market because it happens to be going up, I wouldn't have thought the fundamental argument for chasing China is particularly robust at these levels. So I think we're seeing a bit of rotation, a bit of momentum-based investing, but certainly I would be very hard-pressed to make the case for significant outperformance of China relative to India.
Okay, this anti-EM trade that you just spoke about, do you see it continuing or is it at an end?
I don't think it's at an end just yet, because I think in part that's linked to higher volatility and higher yields in global bonds. There is an increase in global bond yields. German 10-year yields have gone through 80 basis points for the first time this year. France is now up through 100. Even the US has added to Tuesday's gains in yield, that is, with a further 3 or 4 basis point increase. And that is just, I think, putting investors off, or at least making them wary of the potential for a bit of a spike in volatility and an argument that says equity markets generally might just be in for a pause. Perhaps one statistic I could throw at you, at your viewers, is to say that if we look over the last 20 years, and I'm going to talk here about the Dow Jones Index, but if we, in the United States, but if we take that broader span of time, over the last 20 years, the month of June has historically been the second worst month of the year. And if we look over the last 10 years, 8 of the last 10 Junes have seen a decline.
All right, we'll take that impact of June, but can you just give us a little more perspective about this yield rally that we saw even yesterday, both in the US and in Germany? Why are yields rallying so sharply all over the world, and do you see that continuing for some time? How long?
Well, globally, there's a perception that the process of deflation is not just at an end, but is actually being reversed. in the Eurozone, which had the biggest policy response, we've seen inflation move from minus 0.6% at its low point already to plus 0.3, and we've seen ECB President Draghi actually pretty confident in his latest press conference that we'll be up at 1.5% in 16 and then 1.8% in 2017. So unless we were to see a further dramatic decline in oil prices, base effects alone seem to ensure that inflation is going to pick up, and with the pickup in inflation, so too I think we're going to see bond yields continue to rise.
Okay, so now coming back to the Indian market, since March 3rd, the Nifty has fallen almost 1,000 points. That's at least 10% or more than that today. When do you think India, or for that matter, the emerging markets will get attractive again in valuation terms?
I think for valuations to become compelling, we would probably need to see a more general sell-off in EM. And I think at the moment that is not yet there. So it's not compelling. I think we're probably going to see a drift off and an extension of the recent declines. But I don't think it's going to develop as yet into a rout unless we were to see more substantial declines in equity markets globally. For the moment it seems confined to the EM universe, and I think confined and contained would be the words I would use to sum it up, but no particular reasons to disfavour or to dislike India any more than anywhere else.
At least on that's a positive thing to hear. Thank you very much, Nick Parsons, for joining us. Okay, so it is more like an EM story, no particular reason to disfavour India. That's what Nick is saying, but then he thinks that yields can continue to rise. For the moment, actually, what is rising and what is pleasant to the eye is the Sensex and the Nifty. We saw them down about 1/3% at one point in time, almost 0.4. Now they've recovered that, which means it's a 0.5% gain that you're seeing in the Sensex and the Nifty, as you can see, from that 930 dip that we saw in the last 45 minutes or so, have been very positive for the Sensex and the Nifty. We have seen a decent amount of buying coming in the last few minutes. Actually, the Bank Nifty is also turned into the green at this point in time. And don't forget, even the stocks like Jaiprakash Power or Lanco Infratech, that entire lot is also seeing a decent amount of buying. And we have seen the mid-cap actually erode a goodish bit of its losses. Look at the vertical rise that we are seeing in many of these stocks. So looks like plenty of trading opportunities are going to be there, both on the long and on the short side, with many traders recommending that on highs they would continue to sell. Anyway, trading ideas are available, and all that will come to you on Traders Only in a minute. Thanks for watching Bazaar.
CNBC TV 18, celebrating 15 years of leadership.